In every economics textbook, there is one rule that almost never fails. When the world burns, gold rises. Wars, political crises, regional conflicts. Whenever uncertainty takes over, investors rush to gold. For more than half a century, that pattern repeated itself. During the oil crisis of the 1970s, gold exploded higher. During the global financial crisis, gold climbed again. Even during the COVID-19 pandemic, investors piled into gold as governments printed trillions of dollars. History seemed clear. Fear pushed money toward safety, and gold was the ultimate safe haven. But in 2026, something unexpected happened. The Iranian crisis escalated. Regional wars spread across the Middle East. Oil surged to $126 a barrel, sending shockwaves through global markets. By every historical measure, gold should have soared. Instead, it lost nearly 20% of its value in just a few months. How? Why? And what does this reveal about the changing rules of the global economy? To understand what happened, we first need to understand why gold usually rises during a crisis. For decades, gold and oil behaved almost like identical twins. When conflict threatened energy supplies, oil prices climbed. At the very same time, investors bought gold. Not because gold produces income, not because it pays dividends, but because gold is something tangible, something scarce, something no central bank can create with the click of a button. That relationship survived recessions, financial crashes, political turmoil, and even global pandemics. Until now. So, what changed? When oil reached $126 a barrel, it didn't just make gasoline more expensive. It made everything more expensive. Factories paid more for energy. Shipping companies paid more for fuel. Food producers paid more to transport crops. Consumers paid more for almost everything. Inflation was no longer a possibility. It had become reality. And whenever inflation becomes the biggest threat, every investor turns to one institution, the U.S. Federal Reserve. Think of the Federal Reserve as the thermostat of the world's largest economy. When inflation gets too hot, the Fed tries to cool it down. Its primary tool, interest rates. Higher interest rates make borrowing more expensive. Consumers spend less, businesses slow investment, demand cools. Eventually, inflation begins to fall. Simple enough. But there is another consequence. Higher interest rates completely change where money wants to go. That brings us to one of the safest investments on earth, U.S. government bonds. A bond is simple. You lent money to the U.S. government. The government promises to pay you back, along with interest. When interest rates rise, those interest payments become much larger. Now imagine you're managing hundreds of billions of dollars. You have two choices. Gold, a trusted store of value, but it pays you nothing while you own it. No income, no interest, no guaranteed return. Or U.S. government bonds, backed by the world's largest economy, now paying some of the highest guaranteed yields in years. For pension funds, insurance companies, sovereign wealth funds, and institutional investors, that decision became surprisingly simple. They sold gold. They bought bonds. Money flowed out of one safe haven into another. And as selling accelerated, gold prices continued to fall. But that wasn't the whole story. Two more forces pushed prices even lower. The first, liquidity pressure. The energy crisis dramatically increased operating costs across the global economy. Companies suddenly needed cash. Investment funds also needed cash, not because they wanted to sell, but because they had obligations to meet. Gold happens to be one of the most liquid assets in the world. It can be sold almost instantly. So, they sold it. More sellers meant more supply, and more supply pushed prices lower still. Then came the second force, profit-taking. Between 2022 and early 2026, gold had already experienced one of the strongest rallies in modern history. Central banks around the world had been buying enormous quantities of gold, partly to diversify reserves, partly to reduce dependence on the U.S. dollar. As demand increased, gold climbed from around $1,800 to more than $5,000 an ounce. Eventually, some of those buyers decided to lock in profits. When the largest buyers become sellers, Even temporarily, markets notice, and prices react. Put all of those forces together: higher interest rates, attractive bond yields, liquidity needs, profit-taking, and suddenly, the biggest geopolitical crisis in years wasn't enough to keep gold moving higher. So, did gold fail? No, gold didn't fail. The market simply prioritized something else: yield, liquidity, and certainty over a traditional store of value. This has happened before. Markets constantly shift between protecting wealth, generating income, and preserving liquidity. Each environment rewards different assets. History shows that gold has experienced sharp corrections before. Some lasted months, others lasted years. But those corrections reflected changing economic conditions, not the disappearance of gold's role in the financial system. The old rule wasn't broken. It was tested under a different set of economic forces. And perhaps that's the biggest lesson. Markets evolve. The rules don't disappear. They become more complex. Those who only looked at the headlines saw gold falling. Those who understood the mechanics behind the move saw something very different. Because markets don't reward emotion. They reward understanding. The market punishes confusion. It rewards understanding.